Let's jump right into this explainer. Today, we're unpacking a massive paradox in the stock market, Navitas Semiconductor, ticker symbol NVTS. Usually, companies fit into neat little boxes, right? You've got your steady value plays, your fast-growing tech darlings, or maybe struggling businesses on the decline. But every once in a while, the data throws us a curveball so extreme, it forces us to completely rethink how we look at financial metrics. And guys, Navitas is exactly that kind of contradiction. So here's our roadmap for this explainer. We'll start with a market overview, look at their massive growth story, break down the valuation ratios, tackle the profitability problem, and finally, look at their financial health and liquidity. Let's get to it. Starting off with Section 1, the market overview. Look at this number, 735.33%. That is the jaw-dropping trailing 12 months price compound annual growth rate for Navitas. Seriously, if you had your money parked here over that period, you'd be looking at a return most investors literally spend a lifetime trying to hit. It is undeniably explosive momentum. But hold on, because here comes the whiplash. We have to immediately contrast that skyrocketing growth against the reality of their actual operations. Alongside that 735% price growth, we see a staggering negative 224.14% net profit margin. Basically, for every single dollar Navitas brings in, they are losing over $2.25. That is an incredibly aggressive rate of loss. This perfectly captures the tension. Despite a massive $4.55 billion market cap and an 868% total return over the last year, there's a huge underlying tug-of-war happening here. The stock recently closed at $19.67. Now, to put that in perspective, that is a mind-bending 946% above its 52-week low of just $1.88. The market is pricing this company as if its future dominance is an absolute lock, completely shrugging off those massive current losses we just talked about. Moving on to Section 2, let's look at this massive growth story. When you map it out, Navitas is the absolute definition of a roller coaster. I mean, talk about giving investors motion sickness. We're seeing wild swings here. A near 80% drop in 2022, followed by a massive 130% bounce in 2023, then another brutal 55% haircut in 2024, rebounding into a perfect 100% doubling in 2025, and tracking into 2026 year-to-date, a 175% surge. You know, this isn't your grandfather's steady growth. This is a highly volatile asset, reacting aggressively to market sentiment and forward-looking hype. But when we look for actual revenue growth to justify those wild price swings, the picture gets pretty muddy. The short-term 3-year average revenue compound annual growth rate is actually slightly negative, sitting at negative 3.13%. So over the last 36 months, top-line revenue actually shrank a bit. Now, the longer 5-year trend is still positive at over 20%, but it just goes to show you that the recent explosive stock price action, it's completely disconnected from their recent revenue generation. That brings us to Section 3, breaking down the valuation ratios. When we run the blood work here, we see an astronomical price-to-sales ratio of 112.37, sitting right alongside a negative price-to-earnings ratio of negative 31.22. They also have a price-to-book ratio nearing 11. To put that price-to-sales ratio into context for you, paying 10 times sales is usually considered pretty expensive, even for a high-flying tech company. Paying 112 times sales, that implies buyers are betting the farm that sales will multiply exponentially, like tomorrow. Just to be totally clear, a negative PE ratio, along with their negative EV to EBITDA ratio of negative 61.30, simply means the company's earnings are negative. They are losing money. Your traditional valuation models, they completely break down here. You literally cannot value NVTS based on the profits they generate today because, well, there aren't any. And check this out, an enterprise value to sales ratio of nearly 107 highlights once again that the market is banking heavily on monumental future growth rather than fundamental realities. Investors are paying a massive premium just for a ticket to the show, hoping that Navitas' semiconductor technology becomes the absolute industry standard down the road. Which naturally leads us to Section 4, the profitability problem. The operational data presents a pretty sobering reality. Over the last 12 months, NVTS generated roughly $40.5 million in total revenue. But to generate that $40.5 million, they had a net income of negative $133.9 million. So it costs them an absolute fortune to operate right now, far, far outpacing the money actually coming in the door. Now, they do maintain a positive gross profit margin of nearly 29%. That means it costs them less to physically make the semiconductors than what they sell them for, which is good. But the rest of the business expenses, they just eat that alive. Their return on invested capital sits at a deeply negative 39.76%, and their return on assets is at negative 28.77%. Simply put, every dollar invested into the company right now is shrinking. On top of that, they are actively burning cash. The trailing 12-month free cash flow is negative $47.5 million. A negative free cash flow yield of over 1% tells us that, structurally, the business operations are draining the corporate bank accounts month over month. If this were the whole story, it would sound like an absolute disaster waiting to happen. But before we write them off, let's look at Section 5, Financial Health and Liquidity. Here is the massive silver lining. Despite those huge operational losses, NVTS carries absolutely zero debt. Their debt-to-equity ratio is a perfect 0. Plus, they boast excellent liquidity. They have a current ratio of 4.33 and a quick ratio of 4.07. What does that actually mean? It means they have over 4 times the liquid cash and short-term assets on hand to pay off all of their short-term obligations. They are definitely not going bankrupt tomorrow. And this brings us full circle to the paradox we started with. You've got terrible fundamental profitability, a massive cash burn, and declining short-term revenue growth. But at the same time, they have an incredibly resilient balance sheet, completely unburdened by debt, acting as a huge safety net. This bulletproof liquidity is exactly what's supporting its high-flying stock momentum. It gives the company the long runway it desperately needs to try and catch up to the massive future growth the market is already pricing in. So I'm going to leave you with this to ponder as we wrap up this explainer. Based on this incredibly polarized data, are these extreme 700+% returns signaling a coming technological monopoly where Navitas just corners the market? Or are we looking at a fascinating market anomaly, a bubble just waiting to burst once that cash runway finally runs out? The data gives us both the warning signs and the safety nets, but only time will tell which metric ultimately wins out.